Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly Video for January 10th, 2019. We're talking money flow, risk on, risk off, and any positions that we can start taking or adjusting in the equity market, in crude oil, in gold, and in treasuries. These markets tie together even if you're just trading the Nasdaq or the ES or the Russell or the Dow futures. All these things do come into play, and some of us do take intraday trades or otherwise option positions either in the futures or related markets such as GLD, USO, or anything like TLT, IEF, and of course SPY and all the other ETFs. So even though I'll be charting with you tonight on the futures, these same logic, levels, expectations, and plans will play out on the ETFs or of course with verticals or other option strategies. Mainly, we're looking at these two markets going together. Crude oil and the S&P futures, the market, are economically sensitive. So when the economy does well and optimism and good numbers abound, these markets go up. For the most part, gold and treasuries are counter markets. They compete for assets. So if the economy's good, these markets should be going down. That's the thought process, at least, and the correlations. So these will be considered risk-on markets. Money flows into them when we want to make money when the economy or the market itself is expanding, or call these bullish markets. These can be considered risk-off or bearish markets. We want to park our capital and protect our capital, be defensive for short periods of time when we think the market's going to fall or otherwise be in a range or bearish. Now, we can track how these markets behave together. For example, S&P has fallen down to the 2300 level and bounced quite powerfully back to 2600. Crude oil, we're not seeing the whole decline here, but we'll see that in a moment, has fallen from the 54 level at the same time at the start of December down to 42 and then back to 53. So that's the progression. Oil is just a little bit stronger, or I should say has rallied a little bit more persistently than the equity market. Gold has been strong this entire period for December into January and really hasn't pulled back or retraced like bonds have. We've had this rare moment where both the equity market, oil, and gold, but also a little bit with treasuries, have all been going up. That changed recently at the start of 2019 with bonds exploding and then falling just as rapidly away from the 123 index level in ZN. Again, gold has not fallen with bonds. It's actually rallied. So these are money flow levels to keep in mind. Now, we can take a little bigger perspective and go up to each of these individually for price levels and expectations. From prior videos, we do expect the S&P to turn away from these pivots. We gave it 2575. We thought 2600 is going to be the midpoint. And the final stopping point on this dead cat bounce or this bear market or oversold rally is probably 2626. Just a little bit shy of that. Those levels do include the 50-day moving average and the 2626 lower gravity spot. So it's going to be a spot for the market to push into. But with the volume divergences, we still think the market has better odds of turning away from these levels, putting us a little cautious, taking any bullish profits, and getting ready, if not already established, in bearish verticals, in out spreads to the downside, or otherwise defensive positions in equities. The alternate thesis, unexpected move, be ready, prepare yourself, don't get caught up in the deer in the headlights rally, would be if the market breached above 2630. That would give us a series probably of trend days to the upside, an unexpected, violent, alternate thesis movement, probably toward 2682 and even higher than that to 2700. At the moment, that's the alternate thesis pathway, with the dominant thesis being a pullback. Just like this pullback and just like into October, November. In crude oil, crude futures saw a stronger fall, a stronger sell, and a break of this uptrend, and a violent fall from 75 to about 42. Just like the equity market, we are seeing a strong V-spike reversal and a strong oversold snapback rally. The initial target was 50 per barrel, and we can see that oil has exceeded that to the 50-day exponential. Just the same logic for stocks. We're not quite seeing the same volume divergence, so be a little cautious here. But oil does, at the moment, have a sell bias or take profits bias, prepare for a downside swing up against 53 per barrel. You can also look at that in multiple ETFs or XLE or other energy or oil related products. So USO, if you choose to use the ETF, has about $11 and roughly 20 cents and $11.25 for a potential short sell or an alternate thesis breakout. As traders, we do have to be prepared for unexpected events. Gold gives us a picture of this. A strong rally. Remember, the equity markets sold off through December. Gold reversed its downtrend and rallied powerfully toward 1300. And that's just a little bit shy of our price pivot at 1310. So we do think gold has a short sell candidate and short sell positions on the swing basis or intraday basis on what we call a departure trade, or a trade fade, if you will, down away from 1300. And that would target about 1275, which is the 20-day exponential. Not a whole lot of play in here. That's probably best done on an intraday or very short-term basis. Again, the alternate thesis, let's say the market turns and goes to the downside, you could see gold get a bullish rally and bullish pressure if stocks do turn lower. We can also look at GLD for a similar play if you don't want to trade the futures. That's going to be into about 122.50 on the ETF. An upside play, if we break above, which is roughly here, is to 124. So ETF levels, option levels, futures levels. Finally, we'll take a look at ZN, which is our bond market. We've drawn a lot of attention there because the market has broken violently higher as the Fed has shifted policy, as money has flown rapidly to the defensive side or the risk off side, and that has propelled bond prices higher. Remember, gold and bonds typically unite, or bonds and gold, for the most part, trade together. With the equity market down in December, bonds and gold had a strong December. But because the equity market's rallying, the money's coming out of bonds, not quite out of gold at the moment, and that is resulting in a snapback pullback. And this is what we look for fades or snapback plays. Down away from an overbought level into the 20-day moving average. That was from a prior video on the equity market, and that has been achieved. It's just the same logic also achieved in the bond market. Again, you can look at this from the ZN perspective or TLT. And the same logic does take place. It overshot the boundary and pulled back just as hard. So right now, bonds have a support bias into the 20-day exponential. That's just above 120 per share on the TLT for a bounce play to 122. But like anything, if the market keeps going up, defies the odds, defies the logic, and rallies, you'll probably see the TLT fall to this little pivot right here, which is just under 119 per share. Even if you don't trade these markets, they do tie together, and they're all into key pivots. So they either support rally, that would be the equity market breaking down and falling from resistance, or if the equity market defies and rallies, bonds, and maybe gold, would keep going lower. This is Corey Rosenblum for the Theo Nightly video for January 10th, 2019. Take care.